little bit of a pause after yesterday's rally. 30 minutes till the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Coming up, Google's AI ascent is poised to shake up the rankings of the world's most valuable companies.
Meanwhile, investors combing through a full bag of retailer reports. Delayed data suggests some consumers are hitting pause on spending.
And oil swings on a report that Ukraine agreed to terms of a peace deal with Russia, though some minor details are still outstanding.
So a lot to comb through, but kind of the dominant story is what's happening with Meta and what's happening with Google, because late yesterday, Meta reportedly in talks to spend billions of dollars on Google's AI chips by 2027. It would establish a real challenger to Nvidia's AI chips. I spent probably too long reading about the differences between TPUs and GPUs last night. Oh, look at us. This is our life now.
Yeah, I now know about tensor math, which I had no idea.
I'm sure that'll be very useful in daily life
about
for
before. Yeah. Well, when I'm talking to Caroline Styne now, I can pretend I know what I'm talking about. Nvidia shares are down on this news, and the concern is that it could lose its title as the most valuable company. That's one of the concerns, prompting investors to reevaluate a potential new AI pecking order. You can see a drop of 4.5%. I looked at a chart, though, of Nvidia shares versus Google shares over the last 5 years, and this chip maker still has come so far so fast.
It is very true, but that's why so many people got out there and said, hey, look at Alphabet. Maybe it's undervalued. Maybe it's catching up. And for more on that competition, we welcome Bloomberg macro strategist Michael Ball and Bloomberg Tech co-host Caroline Styne. Caroline, I think you can fall into the camp of people who's been like, hey, I've known this for a while. I've known that TPUs are so efficient. Does it really make a difference that you have Meta now buying into this? What does it mean to have a market awaken to the possibilities of what Google has developed?
I think what's different here is before Alphabet had been selling it as part of the cloud winning formula. Come to us, you can use our cloud and you use our TPUs, which are on their 7th generation now. They've been developing these for 10 years. They've been offering them to other clients since 2018. We haven't seen them really sell them specifically to others to use within their data centers, not just Meta, but maybe banks who need to trade at high frequency. That's a clear area of edge for them. So they're starting to get this inbound. In fact, a lot of analysts, Stacey Raxton over there, we've heard also from Bernstein, we've also heard from Gil Luria saying this is kind of an obvious dimension of the business model. The question, though, is what will Nvidia do about it? Now, we've heard before reports from The Information that OpenAI was getting very close to potentially taking TPUs from Google, Alphabet, maybe using their cloud more ever since that relationship when Microsoft got disrupted a bit. And then Nvidia went and put $100 billion into OpenAI and said, oh, please do use our GPUs if you wouldn't like to. What is Meta going to suddenly get offered from Jensen Huang? That's my key question, because you've seen big deals with Anthropic, but Anthropic suddenly has got some more investment from Nvidia as well. There's going to be a tussle at the top here, but be sure, Jensen Huang's been eyeing TPUs for a while, and Alphabet, this has been a winning formula. That's why Gemini 3 has been so efficient, and efficiency's everything. It's all about energy and what more they can do with it, because that's going to be the bottleneck.
Yeah, we have actually updated our circularity chart, which continues to grow and boggles the mind no matter which form you look at it in. Michael Ball, is this a problem for the whole market? I mean, so much is built on Nvidia reigning supreme. Here's the new version, right? And you can see all of the deals that they do with other big players like AMD, like Oracle, like Microsoft, like Intel, and that those players do with them. So if Nvidia is brought down, is it a problem for everybody?
I don't think so. And this has been the question that the market's trying to figure out, because capital so far is staying in the market. So although we've had Nvidia now break below that 180 level, which was a key battleground and had a lot of sort of positive, negative connotations if it was below or above, the fact that Google has taken on $1 trillion and that the market is just finding a more efficient answer to the AI CapEx question. And that's what we want to see. We want to see competition. We want to see these guys have choices. We don't want the hyperscalers all bottlenecked into one choice that has backlogs growing and energy efficiency questions. We want optionality. We want capitalism to work. And that's sort of what we're seeing. And although it's violent in some ways, given the price action of the winners and losers, it is a positive development in the long run.
Okay, so if we do get, and we have, something more efficient, something more energy efficient, Caroline, is that enough? Or is this an ecosystem that's incredibly sticky? So even if there are hyperscalers and others who want to use Alphabet's chips, if they're already with Nvidia, can they just so easily change over?
What's going to be interesting is how the development of the software works out here, because we understand that Alphabet is doing a lot to show the prowess not only of the TPU, but also the software that goes with it, and some of the ability to use software that's adjacent, not just their JAX, which is their own programming language that they've developed to go alongside TPUs, but you can use others that use different ecosystems. Look, the thing with NVIDIA is that they have CUDA, and everyone is locked in not only to the hardware that NVIDIA offers, but the entire ecosystem that NVIDIA offers. If Alphabet can start to chip away at that and show, look, with us you can have prowess the entire way through, I think there is going to be a real recognition that this is a clear alternative. But remember, the whole vertical integration story, Google has shown so well is that it can develop incredible models because it's using its own tech stack, and then it's putting it out into the ecosystem. We're all using it. Look what Alibaba is just announcing. They too want to be a full vertically integrated company that makes their own chips, that develops the models, that offers it out on their cloud, and then offers the models as well. But also remember, this is what Amazon does. Yes, we're talking about TPUs, but Trainium is on their third iteration. We understand that many people are using not only for training, but are we going to use it not just for inference, but the training of models as well? How much can Amazon start to show its competitive edge as well with its chips, not just its AWS offering?
By the way, maybe you can clear something up. I don't really understand Jensen Huang's argument that the GPUs they sell, what are we in now, Blackwell or Hopper?
Vera Rubin for the next one.
Right, so those are capable of many different things, right? The graphics processing units are flexible, as you may have read last night, whereas the tensor processing units are supposed to be ASICs, so they're application specific. However, if that application is AI,
machine learning,
I don't care if GPUs can show me good graphics. I want AI, right? From these
and I
chips.
think this is where the battleground's going to be. How much efficiency can you wring out from this hardware with the software within it? And if Jensen Huang can say, look, my GPUs have been able to accelerate your AI models, your machine learning that much faster. And by the way, I've got a chunk of change that I can continue to invest in you as a company and continue to invest in your entire ecosystem. Maybe there's the winning formula. But this is why Google has made everyone sit up straight and why analysts have become noisier and noisier as to how much this has been a winning formula for them, is that the DeepMind were able to go directly to their semiconductor team and say, look, with this, we're learning this, let's work in it together, let's understand where the efficiencies can be brought. And I really do think that the infrastructure issue is not going to be whether you eventually can lay your hands on the hardware. It's going to be whether you can do more with the grid, with the electricity. And if they can show energy efficiency at this point, that's going to be what's music to the government's ears and therefore to users' ears. But I just think this turf war is just starting. We're all going to start talking about Inferentia and Trainium and what Amazon's doing and what everyone else is doing in ASICs. Because remember, that's what Broadcom's been doing so well on. All these companies, Meta's designing its own chips.
Broadcom was up 12% yesterday.
OpenAI is developing its own chips. Eventually, maybe that's going to become commoditized, not just large language models.
So it's a world where there are different changes, Michael. I mean, it's no longer sort of like the tide is lifting all boats. You have to be more discerning with what these companies are doing.
Right, and I would add that the depreciation question now is even more forefront, right? Because we don't know, to everything you just said. I do this, I watch this, and my head is blowing. Like, it's just so much to keep track of. And as an investor, if someone who's trying to look at a balance sheet, whether it's a hyperscaler or whether it's the provider of these chips, looking at the backlogs, looking at the inventory builds, how much is this all going to be worth? If there's all these new options, if energy efficiency versus training, inference kind of duration, how long something stays practical and efficient.
Well, this is why Zuck is supposedly thinking about renting them, right? When I look at a new EV out there in the car world, that's where my mind goes. I think, why don't I lease it instead of buy it? Because there's going to be something better in 2 years anyway, and who knows about the battery. I want to ask, though, more about Dani's question, which is that you have less sector correlation if two people in the same sector are at odds, right? So.
Well, funny enough, tech's still been under pressure. So looking at what I like to look at the option markets and seeing where sort of bullish skew / bearish skew is, people are still very negative on tech. People have obviously rotated into more value-focused sectors like healthcare, like defensives. And that makes sense in a lot of ways because the valuation thing over the last 3 weeks has been what spurred this. But to your point, that like internal battle of is this good for the overall AI CapEx story is still being fought out. And we're not seeing it with people trying to regain exposure to it. Google calls are expensive, the vol's a little bit high, but it's not necessarily being reached for like we've seen in Nvidia in the past.
And can I ask whether this whole short OpenAI suppliers, long Alphabet suppliers is still working? Because yesterday Oracle pushed higher, but today Oracle's back trading in negative territory before the market opens. Is that long in the tooth, or are we still thinking about that trade?
You know, that's a great question. I don't understand, quite frankly, if everyone's sort of in this together in a lot of ways, why there's been such differentiate to this scale. Now, I get the weaker links were being picked off, but we're looking at CoreWeave and Oracle's down almost 40% in their equities, and then obviously we know what's going on with their CDSs. So it looks like we've had that emotional pulse come through the markets, as we often do, and now valuations are sort of reset in a lot of ways, and it's suddenly like going to be a point where people might try to pick bottoms. Now, I'm not calling for that, but I guess to your point, it can't all just go back into Google now. Like, we've got to have this ecosystem of going on.
Apple's next, like, is that the...
Yes.
So at the moment, it's
yes.
Nvidia. Apple's at, what, 4.2 trillion, there or thereabouts?
I think the Apple questions are incredibly fascinating. But bottom line is this market may have gone from a monopoly operator to an open ecosystem in AI, which is fascinating. Michael Ball of Bloomberg Markets Live, thanks so much for joining us. Check out his work by typing MLIV on your Bloomberg terminal. And, of course, Caroline Hyde, you can see her. Well, we feature her on our show every day. But she actually has her own show, Bloomberg Tech, that kicks off at 11. Now, Ukrainian President Volodymyr Zelenskiy says talks with the U.S. about a peace plan are ongoing. His comments follow a report suggesting that Kiev agreed to the terms of a potential deal with Russia. There's also a report that Russia no longer agrees with this deal. Let's bring in Bloomberg's Russia economics and government editor, Greg Sullivan. So, Greg, is it possible that the U.S. has manipulated this 28-point peace plan to something that Ukraine could accept, but now Russia doesn't want to deal with?
Well, that's still unclear, but what we do know is that President Volodymyr Zelensky did say that talks were ongoing. Of course, that comes today as U.S. and Russian delegations are meeting here in Abu Dhabi to discuss the proposal and the peace plan. More broadly, we've seen recently President Trump has signaled that there's progress that has been made. Zelensky seemed to echo that last night in an address to his country, that there was progress being made towards these proposals after talks in Geneva over the weekend. The original 28-point proposal that the White House proposed basically adhered to Russian positions. Obviously, once in Geneva, they tried to narrow the differences with the Ukrainian side, with both sides signaling that there could be progress. But that leaves open the question, how much did this deviate from the original 28-point plan, and will Russian support still be there? Russian officials have cautioned that they have not seen the revised proposals, that they're waiting to see those. But they have signaled that if it deviates too far, that could risk their support going forward. So a lot of questions remain as the talks are ongoing, both with the Russian side and the Ukrainian side on these proposals.
All right, Greg, thanks very much. Greg Sullivan there talking us through what we know so far, which is just a lot of reporting, and we're going to continue to bring you that as it crosses the wire. Check on futures as we head towards the opening bell. We're looking at very little change on the S&P, but remember we had a runaway rally yesterday, adding over 100 points. The NASDAQ had one of its best rallies that we've seen, I think, since May. Yep. So tech stocks really getting a leg up. And the small caps actually gaining this morning in the pre-market, so we'll see what happens when the bell rings.
Helping with yields that are coming down this morning. Also on our radar, some of the other movers. SanDisk, that is climbing. It's going to be replacing Interpublic in the S&P 500, another AI-related company, just underscoring how much of a bigger makeup it is of overall markets.
J.M. Smucker's lowered the top end of its full-year guidance after scrapping planned price increases on coffee products.
Meanwhile, some retail reporting this morning, and Macy's surging off the back of its peers like Kohl's reporting strong results.
Coming up, retail earnings. We're going to give you a lot more, showing signs that consumer spending remains healthy into the holidays, even with the miss that we got in retail sales. We'll explain on the other side of this break. This is Open Interest. Let's get out of high interest and look at what's making headlines around the world. Wall Street's top cop is warning private market giants to quit playing games with their numbers. Jay Clayton, who runs the DOJ's Manhattan office, says regulators are zeroing in on how firms value private assets, especially when they shuffle them between funds and continuation vehicles. The former SEC chair says watchdogs won't tolerate price picking that puts firms ahead of investors. And Wall Street's macro desks are headed for their best year since 2009 as investors pile into bets on shifting global interest rates. Goldman Sachs, JP Morgan, and Citi are set to haul in $165 billion from fixed income, credit, and commodities trading. That's up 10% from last year. Rates desks are the standouts, with G10 revenue hitting a 5-year high of $40 billion, while emerging market macro traders will rake in a record $35 billion. But one consultant says don't count on that coming through in your bonuses. U.S. home sellers are pulling listings as the market cools. Nearly 85,000 homes were delisted in September, the most for that month in 8 years, according to Redfin. High rates and affordability woes are keeping buyers out, forcing sellers to hold off rather than accepting lowball offers. Miami led the pullback with almost 8% of listings yanked from the market. Dani?
Meanwhile, a number of retailers matter reporting this morning. We heard from Kohl's. They raised their full-year outlook. That's the second straight quarter they've done it. They also named Michael Bender as permanent CEO. Abercrombie, that's surging this morning, up 16%. They boosted their outlook. They cited demand for its Hollister brand, which I was super into in high school. And Dick's raising its outlook again, but investors focus on the cost of trying to turn around the Foot Locker sneaker chain that it recently acquired. Let's bring in Bloomberg consumer editor Emily Cohn. Emily, maybe you set Dick's to the side for just a moment.
Yes.
These seem like really good results in a period that, like, maybe the consumer was supposed to be a bit more challenged.
I agree. I think, it continues what we were speaking about last week with this tale of two retailers. Today we're talking about a split screen consumer spending picture where we see the companies that are known for brands that add value. So we have Kohl's. You can go into a Kohl's and buy Nike. You can buy Sephora makeup. Abercrombie, the Hollister brand, really resonating with teens. And then with Best Buy, it's people going in there to buy expensive iPhones. Consumers are willing to spend when there are brands that they know and trust and know that they're going to get value for what they're shelling out money for. It's the retailers like Target and Home Depot where that value, that brand proposition just isn't quite there. That's where we're seeing the slower spend.
So what's the problem then with Foot Locker? I know this has been an ongoing saga, but I feel like if I wanted to buy sneakers, the only two names that pop into my head are Foot Locker and Finish Line, right? So why can't they sell shoes?
I think Dick's would agree with you, like in the long term, that this is going to pay off. I think what investors are seeing today is the cost of turning that around and are not happy with that and the timeline here. But clearly, Dick's sees promise in that premise long term.
All right, Emily, thanks very much. Bloomberg's Emily Cohn there covers retailers for us. We're following all the retail earnings out this morning, and we also got some retail spending data. We got more economic data that was delayed is trickling in. So retail sales data came in below estimates. PPI came in line with estimates. Those are the big headlines, I think, other than ADP. Let's break down all of it with Bloomberg economist Stuart Paul. Stuart, how do I read this retail spending data? Because it looks horrible, right? Retail sales advanced month-over-month reading only a gain of 0.2%, and we were looking for double that in the survey.
That's right. The thing that's really shocking in the retail sales report is that auto sales, vehicles, were down during the month. When you look at alternative data sets, it looks like unit sales of vehicles was up about 2%. So that's why we missed on the headline. When you then look into the control...
By the way, why is that? Is that because of discounting?
It could be because of discounting, but it's also just different measurement according to different factors here. If you're including vehicle parts and parts were down and that's creating the drag in retail sales, that could help to explain some of the disparity. But it's pretty poor just across the board. The only thing that was really propping up the headline is spending on healthcare, which folks have to do when they're feeling sick, spending on furniture, household durable goods, and a bit of spending on dining out, which of course is a good thing. A little bit of discretionary services spending is good. But what's most important here is that the downside surprise in control group sales means that folks are going to have to revise down their estimate for Q3 GDP growth. This was one of the last things that we were waiting on. And as the Fed crunches its numbers and then considers fading input cost pressures, which we saw in the PPI today, it should solidify a December rate cut decision.
do we care? It's September data. What difference does it make?
Well, so it's September data, but it does serve as a baseline for when we consider October. And a lot of what we're seeing in October is a little bit stronger than what we saw in September. We're also starting to see more alternative data when it comes to the labor market looking a little bit weaker. So it's still something that has to fill out our full data sets so that we could get some sort of a comprehensive understanding of the macro. And for a Fed that's still looking to just get more and more and more information so that it can build a coalition somewhere around some decision, it's helpful to have a little bit more information.
Feels like we are a far ways away from that coalition. Stuart, thank you so much for joining us. Stuart Paul of Bloomberg Economics, and a quick look at some of the other movers on our radar this morning, Matt. Zoom earnings, those top expectations. They raised their full year forecast, leaning into enterprise products. People still use Zoom. Those shares are up 5 1/3%.
Yeah, people use it a ton. It's so
too much.
It's so shocking to look at the poor performance.
So many Zooms could just be phone calls.
It's down, by the way, year to date and over the past 5 years. All right, we're going to come back. The closing bell in 7 minutes. This is Bloomberg. Check on futures ahead of the opening bell. We're looking at, it's kind of lame actually, down 0.1% on the S&P 500, not getting me going. NASDAQ futures down about 0.4%, but we had our biggest rise since May yesterday in the cash trade, and Russell 2000 futures, they're up a little bit, but that's because the 10-year yield is moving back down closer to 4. 4 minutes to go until the opening bell. Morgan Stanley Investment Institute's Jitania Kandhari on the other side of this break. We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're seeing lackluster futures trade this morning with S&P futures slightly in the red. NASDAQ futures down a little more after the outperformance that we saw yesterday. Ringing the opening bell at the New York Stock Exchange, Aero Mexico. It's clear what they do, and their stock just started trading there a few weeks ago, so watch this space. I think more interesting is ITRN. This is a company that has technology to find and retrieve stolen cars. And unsurprisingly, the shares are up like 173% on a total return basis over the last 5 years, because as cars get more and more expensive, used cars as well, more and more valuable, more people are going to steal them.
I'm just really upset by the lack of ties in both these groups.
Yeah.
It's like no one, you're ringing the opening bell. Show up in a tie.
I mean, it's truly slacking off. It's not Friday even, right? So
it's not Friday
on a Tuesday,
even.
you're ringing the opening bell at the New York Stock Exchange. That's like
tie.
part of the pinnacle moments of your career.
Right.
Wear a tie.
Right. I mean,
look,
look,
be decent.
Thank you, Matt. I agree with you. All right,
Not the West Coast.
Some stocks we're watching this morning away from the world of fashion. Meta reportedly in talks to spend billions of dollars on Google's AI chips by 2027. That means that with this boost we're seeing to Alphabet, it's not as strong as it was in the pre-market trade, but up 1.5. It is nearing that $4 trillion mark for that, Matt, and Meta, that's also up 1%.
All right, that is honestly not only a story of the day, but the story of the week. Nvidia shares down on increasing competition. It could lose its title as the world's most valuable country. We're not like inches away, but we're getting there, as Google is set to be worth, possibly now as it started trading live, more than $4 trillion, and Nvidia getting ever further away from that $5 trillion mark that it hit a few weeks ago. Joining us now is Jitania Kandhari, Deputy CIO of Solutions and Multi-Asset at Morgan Stanley Investment Management. Solutions are very important, so congratulations on that. I wonder what your take is on this AI race, because all of a sudden the narrative is shifting from a monopoly story to an open ecosystem. Is that the case?
Yeah, so I think the markets are the best barometer, right? So if you look at year to date, in the Mega 7, only 2 out of the Mega 7 have outperformed the S&P. So the market's been very discerning, and I think that's the way forward, because you have a lot of these issues as, you know, within the AI chain, whether it's like raising debt to fund CapEx, the whole circular funding, and hitting constraints on electricity and power. So you really have to be discerning at this stage of the AI cycle and move beyond just the picks and shovels and the providers of the new technology to the adopters and the users of this technology, which means more industry-wide usage and how companies will harness the power of AI to improve their efficiencies and their profitability.
It does feel, though, that on the other side of more efficient and profitability, that is slow. We had a guest on who is a spinoff from IBM basically saying that a bunch of companies are stuck in pilot purgatory. I was speaking to Ed El Husseini, a Threadneedle earlier, who said that the promise of some of these efficiencies hasn't fully come to bear, and it won't fully come to bear. The trade that goes beyond AI and the use of AI for companies, how long does that take? And is that as clear-cut as maybe we once assumed?
Yeah, you know, I think in every past tech innovation, the productivity gains always have come with a lag. So I don't think this time is going to be different. And I know, you know, there are two schools of thought. One is that the usage and the uptick has been very slow. And another one that is, yes, you know, it's pilot stage. The delta of change is positive. So I do think that you know, I see it personally. I feel much more productive with using some of the, you know, AI tools today. And I think over time, some industries will adopt faster. And I think incumbency has an advantage here. So in industry verticals where companies have already an existing moat, they may be able to even expand their moat and harness the AI potential to really drive efficiency. So you really need to look outside the typical tech names in healthcare, in retail, in e-commerce, in music, in digital platforms. And we find a lot of opportunities all over the world that we think will really be able to do well in this new environment with this new resource.
We recently saw a new Porsche Cayenne, an electric version, stick with me here, that a lot of people thought looked like a Chinese design. And their reaction was, I might as well just buy a Chinese EV, because they're all the same in terms of massive acceleration. And if they look the same and the quality is comparable, what's the difference? Are we thinking the same thing about AI models? Do you see, you know, cheaper, more efficient AI models coming out of China that we might as well use instead of the American ones if they're just as good or better for the same price?
Yes, great point. I think just like we had the two internets, beyond there will be this silicon curtain with two AI ecosystems, right? And as you said, the three differences between the US AI and Chinese AI ecosystems. One is US is the high-cost innovation model. China is the low-cost inferencing model. Secondly, US is spending CapEx at least 7 to 8 times more than China. So the China CapEx spending is not to the same extent as the US. And China is the country in the world which has excessive power and electricity. And US is running constraints on that data center power requirement. So I think these are the big differences. And yes, Chinese model in terms of the digitized economy in China will help harness the B2C, which is business to consumer applications, in a much more accelerated way. That's my opinion. I was just there, and it seemed really interesting how they are really using those super apps in the consumer-facing apps to harness this. And I'd say one last thing. This year, Chinese Mega 7, we have like a basket, have outperformed the US Mega 7. Interesting. The bulk of that outperformance has come from a multiple re-rating. Earnings haven't done anything. In the US, a large part of the outperformance has come with the earnings momentum. I'm wondering whether finally Chinese earnings pick up and the US earnings could roll over, especially in some of these names. So it's an important inflection in the markets and something to keep in mind for global investors.
Jitania, this also makes me think of the politics of the moment, because it's a U.S. that part of the negotiating leverage has been NVIDIA chips and their willingness to give them H20s or H200s. Do they lose that edge in this debate if all of a sudden China is running more efficient models and they can use old NVIDIA chips to do just as much work or something more internal?
Yeah, so clearly U.S. has that lead and China is behind. They are closing that gap, but I don't think it'll take a long time to get to those superior chips. But, they are reasonably good models and they are cost efficient. So far, so good. I'm sure, there will be, the high-end industries and the high-end chips wherever they are needed. U.S. will clearly have the lead. But I think from an overall perspective, there is a lot of merit in what they've been doing.
All right, Jitania, thank you so much for joining us. After your world tour, that's Jitania Kandhari of Morgan Stanley Investment Management. Let's get a check on your stock market right now, because we are about 9 minutes into your trading day. We're moving higher by 0.1%. The good news is that's some pretty good breath. 406 stocks moving higher this morning. Moving higher is a lot of the tech players. Surprise, surprise. Alphabet is helping lead us there. Apple is also there too. Broadcom helps in the development of some of those TPUs. To the downside, it is Nvidia, and this is perhaps why we're unable to get any really big gains. Nvidia getting crushed, down 5%, and considering how big this company is, that means it's subtracting nearly 27 points from the S&P 500. And this is about the circularity of this economy. Microsoft is down, Oracle is down, because these are companies that have deals with Nvidia. What does it mean if all of a sudden Nvidia is under stress? Looking at the sectors this morning too, again, it's a push and pull from tech, but it leads us overall lower just because, again, Nvidia is such a large weight, so it doesn't matter how well Alphabet is doing. But Alphabet is going to be at the top with your communication services. That's followed by healthcare, materials, consumer discretionary. It's interesting that that's not doing better, considering we've had some good earnings. Maybe it's Dick's Sporting Goods, though, that's making it so it's not doing even better because of the closing of Foot Locker stores, putting some pressure on that. But overall, Matt, we are just ever so slightly higher after a negative future session.
Anytime Joe can click right into one of those sectors. So anytime you're looking at a sector and you're like, I wonder what's behind.
Can I trial this, Joe?
Yeah, you could just say, hey, Joe, click in there.
Joe, why don't you click on consumer discretionary for me? Because Matt has made me do this. I'm going to blame him. Let's see what's going on. You know what? It is the cruise. Matt, this was very worthwhile. It's the cruise operators bouncing back. Carnival got crushed yesterday because there was this Barclays report that said that they talked to management and they were kind of negative or at least hesitant. So it was a big sell-off, and we are buying that dip. So thank you, Joe, for that valuable piece of information. And thank you, Matt.
Yes, well, thank you, Joe. I thank you, Joe, as well. Coming up, more on the budding rivalry between Google and Nvidia. Mandeep Singh of Bloomberg Intelligence joins us next. This is Open Interest.
Top calls for you on this Tuesday morning. The analyst action we're focusing on. First up, Redburn. They're downgrading Estée Lauder to sell. They say the turnaround rally looks overdone and investment needs could limit margin recovery. Shares down nearly 2%. Next up, Citi. They upgrade Brinker International, the parent company of Chili's, which has delicious chips and salsa, to a buy. The analysts say there is still legs to the story with fatter margins, solid sales, and easing beef costs after Brazil tariffs were cut. He added that Chili's is winning over younger diners, a key brand momentum. Finally, Alphabet shares, those are jumping on reports that Meta may spend billions on their AI chips, their TPUs, signaling that there's more demand for them. Analysts are positive on the news, saying that the deal could drive faster growth for Google Cloud and position Alphabet as a credible alternative to Nvidia and AI infrastructure as market cap reaches near $4 trillion, Matt.
Yeah, it's I think the most fascinating story of the past few sessions, because it's really tens of billions of dollars, or could be, according to our next guest. Shares of Nvidia continue to slump in early trading as the AI rivalry heats up. For more, we welcome the boss of technology from Bloomberg Intelligence, Mandeep Singh, joins us. And Mandeep, I was looking at your notes. Obviously, the capex of Meta is massive, somewhere in the realm of $100 billion in the next year, right? What proportion of that do you think they could spend on Google's tensors or TPUs?
Look, and I mean, you framed it perfectly. It's $100 billion for 2026, and Mark Zuckerberg has talked about spending up to $600 billion by 2028. So we know that CapEx numbers are going up, and what these companies are spending on training right now is a lot more than inferencing. But out of that $600 billion spend, I would bet, at least 50 to 60% would be on inferencing. And that's where I think it makes perfect sense for Meta, which has used Nvidia so far for all their training and inferencing, to diversify and have a second chip provider, even if the chips are not as capable as the Nvidia chips are, which are still the best of line. It makes sense. If you're planning to spend $600 billion, you got to have more than one provider, and I think that's the intent here.
If some of these competitors, Mandeep, want to spend even more aggressively to keep up with some of the technology changes, do you think the backers will still allow that to happen? Or does the competition between these companies, the fact that it's not everybody is a winner in this environment, change some of the capital needs and the ease of liquidity in this arms race?
Look, I mean, who would have imagined, Meta really buying something from Google? So the landscape is changing, the stacks are changing. And what NVIDIA told us during their earnings was, look, for every gigawatt, our content is going to grow. In fact, they said up to 30 to 35 billion. So if a 1 gigawatt data center takes up to 50 billion, they said our content is going to grow. And I think that message probably scares a lot of companies, because you don't want to be that reliant on one vendor in terms of the build out of your AI infrastructure. So from that perspective, also it makes sense, whether it's AMD or Google TPU, that you've got, other providers. And, that's where the market would be willing to fund a build out like that, as opposed to, where you have a virtual monopoly with one provider.
Mandeep, we've been looking once again at the circular investment chart. It's made its rounds over the past couple of weeks. Now, the infamous Bloomberg chart. Is that going to be a problem if Nvidia loses its basically monopoly status here? Is that a problem for Microsoft, for Oracle, for AMD, for Intel, for all of these companies that have done, circular investments with Nvidia?
I mean, clearly the optics for NVIDIA didn't look great when they, invested in OpenAI, and OpenAI was buying back the chips. Since then, they have also invested in Anthropic. And to my mind, one thing is clear, that there will be a huge build out of AI infrastructure, whether it's coming from, OpenAI, or it's the hyperscalers, Microsoft, Alphabet, Oracle. You need a more AI infrastructure. And that's where, the circular financing obviously didn't have good optics, but I would argue, whether it's the free cash flow for the hyperscale providers or the private funding, it will happen. And it's just what's going to make most sense is if you've got more providers, if it's more diversified, that's when it's going to be more palatable. And I think that's where we are headed in terms of how diversified this is going to be.
Hey, Mandeep, just quickly, I was reading research in August, and I think that needs to be called out because it was well ahead of this, from Citrina Research, James Van Geelen over there, basically saying that the branding power that Google has is important, not just among the consumer, but the relationships with over 40,000 companies that it works with. Does that give it an edge in this race, the kind of ties it has, again, both to everyday people and to corporate America and beyond?
I mean, clearly Google has the best surface, 7 apps with over 2 billion monthly active users. So you could say they have the most impact in terms of the reach they have, and they are deploying their own AI. And that's where their cost efficiency when it comes to their CapEx is really coming into focus here, because they have accomplished a lot with the $90 billion in CapEx that a company like Meta hasn't been able to do so far.
Mandeep, thank you so much for this. Mandeep Singh of Bloomberg Intelligence on a fastly changing and vastly interesting story. Coming up, we get back to the consumer. Dick's Sporting Goods raises its outlook for the cost for its Foot Locker turnaround, concerning clients, or investors rather, sending shares down by nearly 3%. That's coming up next. You're watching Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks right now, and you're going to see some big red arrows because Nvidia is getting hit hard, and Google isn't gaining enough to outweigh it. So the S&P 500 is down 1/3%. The NASDAQ down 0.9%, unchanged on the Dow. But you can see Nvidia now down 5.6%. That's a big drop for the behemoth chip maker. The concern, of course, is that people may choose Alphabet's chips instead. It came out with its TPUs that apparently made Gemini 3 so great, and now, according to the information, Facebook is considering buying a ton of those or renting some as well. So Alphabet shares up 1.2%, not enough to make up the difference. Macy's and Kohl's are gaining. Kohl's is up 33%. We had some strong retail earnings, even though retail spending was only half of what we expected and only 1/3 of what we saw last month, according to gains, or the prior month. Best Buy also up 1.75%. Dick's getting hurt, though, down 2.5% on the costs to turn around Foot Locker. Dani?
And let's get more into that story on Dick's raising its outlook, but the Foot Locker turnaround cost. Joining us is Bloomberg Intelligence senior retail analyst Lindsay Dutch. Lindsay, are we going to look back at this and say it was a mistake for Dick's to even buy Foot Locker?
Hi, thanks for having me. I don't think so. I think the big worry is, it is about the turnaround, how quickly they can do it and sort of execute a similar turnaround that they executed for the legacy business with Foot Locker. And you saw strong results coming out of that legacy business, 7th quarter in a row of more than 4% same-store sales. That's pretty strong in this environment.
What is the problem with Foot Locker that it really needs a turnaround? For those who aren't versed in this, it seems to be the only, sneaker store you can think of that's a pure play, right? I guess there's Finish Line, but I think JD Sports picked that up. So why isn't that the go-to destination for everybody who wants to get tennis shoes or basketball shoes or soccer shoes, which we now call football boots in this country, apparently? So why?
Right. So I think it comes down to assortment. And what happened is, Foot Locker, heavily exposed to Nike. Nike had its own missteps in its inventory, not putting out enough new product, not innovating. And Foot Locker, ended up, continuing this year. They just don't have the right assortment in the store. They don't have the newest product. They don't have the trendiest product. And Dick's is looking to change that around very quickly. They're looking to offload a lot of inventory by the end of the year. Basically, anything that is not new, sort of old inventory, is going to be extremely marked down. They're trying to get it off the books so that they can start next year fresh. They're also looking at the stores. They're looking into remodeling them. It sounds like a capital light type of strategy, just, showcasing the right assortment in the store and also adding some apparel. So they're really looking to turn that around pretty quickly to start off 26 strong and for an inflection by back to school next year.
All right, Lindsay. Well, it's difficult today for Dick's, but if you look over the last 5 years, this stock has basically quadrupled in value. Lindsay Dutch is Bloomberg Intelligence senior retail analyst, talking to us about one corner of retail. Coming up in the next hour, Marianne Bartels of Sanctuary Wealth breaks down her call for the S&P 500 to reach 7,500 by 2027. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. After the biggest gain since May yesterday, going a whole lot of nowhere in today's market with the push and pull between Nvidia and Alphabet.
Yeah, a lot of pull and not quite so much push. We're also getting a ton of economic data out today as we catch up on what we've missed out on during the government shutdown. So, for example, Consumer Conference Board putting out consumer confidence right now, coming in far below the estimate, looking at 88.7. We were, in our survey, the estimate was for 93.3, and it's also far below the prior month's reading of 94.6. fast.
Yeah, that is painful. You do also have pending home sales. Those actually coming in better than expected month over month, rising 1.9%. The estimate was for 0.2. Let's, though, stick with the story of consumer sentiment. Joining us now is Stuart Paul. Stuart, that's not great. That's a much weaker consumer than we expected. Then you add that into the retail sales data that we already got.
Yeah, it's pretty dismal data that we're getting so far for the month. And when we look at the conference board data, it looks like it's really expectations that were deteriorating. Now, even just coming into this report, one thing that was most notable about the economic landscape and about consumers' expectations was that the share of consumers that were expecting to lose their job in the 6 months ahead was far greater than the share expecting to find a new job. We also saw a labor differential. That's the share of workers who saw jobs as plentiful, less the share of workers who saw job offers as hard to get. That labor differential pointed to material weakness in the labor market. It had been improving somewhat since the summer. We had been thinking that we're getting basically through the trough of the labor market as we got deeper into the fall. But based on what we're seeing in terms of expectations, things are pretty weak. When it comes to pending home sales, I'm just taking all the data with a grain of salt because, as Matt referred to earlier in the program, cancellations of contracts just continues rising. So the extent to which we could look at today's pending home sales data and read anything about November's existing home sales, we can't read into that very much. And so churn in the housing market is still just going to be slow.
It's important to put a month to each of these data points because the retail sales numbers we got out were for September, which is like 3 or 4 years ago now. And pending home sales was for October, getting closer. But as you point out, a lot of those have been canceled. And then the consumer confidence data is from now. It's an actual November reading. What can we take from this, considering the, I hate the term K-shaped economy because it doesn't make a lot of sense to me. But, you know, we're going to talk to Caroline Styne from the Lucques Group, a high-end restaurant, a little bit later on. And I'm sure she's going to tell us that sales are great because the top 10% or the top quintile are still out there spending. The problem is the majority of the country is feeling a lot of pain right now.
Yeah, the way that I've sort of characterized everything for a while now is that there's just a tenuous balance. There's a tenuous balance in the labor market. There's a tenuous balance when it comes to firms' willingness to extend credit to consumers to fuel spending going forward. And if we see anything, if the dial turns in any direction based on today's data, it's towards weakness. And when that's the case, it just, again, solidifies what should be odds of a December cut when the Fed ultimately meets on December 9th and 10th.
All right, Stuart, thank you so much for your time today. Stuart Paul from Bloomberg Economics, breaking down some of the many data points that we're getting in. Let's get back, though, to the tech story and the stock market. Alphabet shares are climbing after reports that Meta is in talks to use Google's AI chips. Of course, Alphabet, the parent of Google, Google, the maker of the tensor processing units. The problem is Nvidia shares are falling much further because this was what was thought to be a monopoly in a sense, and now you get a company in challenging that monopoly. It's confusing for these markets. Bloomberg tech reporter Ryan Vlastelica joins us now. Ryan, is it that serious? Is it that Google is sort of stealing the monopoly mantle from Nvidia?
Hey, good morning. Thanks for having me. Might be a little bit premature to say that, but certainly this is seen as one of the biggest competitive threats that Nvidia has faced over the past few years, ever since it has become the poster child for AI. Google's chips are a little bit different than Nvidia's GPUs, but they're very well suited for the kind of cloud computing and AI inference work that a lot of big companies, including Nvidia's biggest customers, that they are starting to do right now. So certainly this is a very viable alternative for them, and this is something that hasn't really been considered a huge part of the Alphabet story, at least so far as Wall Street is concerned. But I think people are waking up to how potentially significant this could be for Alphabet. And of course, if Nvidia goes from having, I think, 90% plus of the data center market, if it starts losing that, that will certainly have implications for its own growth and its own valuation as well.
What about the implication for everyone that Nvidia has backed, Ryan?
Yeah, it's a great point. This is, I mean, everything is so connected within the AI space that if you start pulling on one string, you do see a lot of things moving on this. So potentially very significant here. Of course, Alphabet does remain a big Nvidia customer. And of course, the AI market is seen as growing at such a pace that it is, there is enough room for multiple major players here. So I'm not sure that this completely unravels the whole thing, but certainly this is a different sort of setup than people had been thinking about even a few months ago.
All right, Ryan, thanks very much. Ryan Blastelica covers tech for us out of Chicago. Let's get to Marianne Bartels right now, Sanctuary Wealth Chief Investment Strategist. She's right here with us on set. And she writes in her 2026 year-ahead outlook, quote, "We see technology and tech-related stocks maintaining leadership, but they will digest some of their extraordinary gains." Marianne, this is a fascinating move here because in order for them to continue to go up all at the same time together, they have to be continuing to work together, I would have assumed, continuing to swap shares and money and revenue. And now that two are essentially bigger competitors than we may have thought, does that throw a wrench in the works?
I don't think it throws a wrench in the works. It's just that we're still in these early stages, and things are going to continue to evolve and move. We'll have different partnerships. But what I really think is happening is we've had extraordinary gains from the bear market low of 22, where the market has rallied 100%. These tech names, though, have rallied a lot more than that. They can't go to the sky. And I think 2026 is going to be the year that these tech names actually have to digest and consolidate some of these gains. So I'm not bearish, but I do expect some significant pullbacks in 2026.
Well, there's some real hope that the AI promise would go beyond just those who are making it and to those who are using it. I'm looking today at a Peloton whose shares are falling because they all of a sudden are offering all this AI workout equipment, which, by the way, I'm sure was expensive for them to develop. That's not having as much of an uptick as they expected. To what degree can you buy into players who are adopting AI versus being a little bit more discerning and maybe those who have some AI theater, which, by the way, now Peloton is bouncing back, sort of, negating my point, but the sales aren't as good as they expected for their AI machines.
Again, I still think this is very early stages. Things have to develop and evolve. The one area that actually has been doing very well in the markets recently has been healthcare. And AI is supposed to be playing a big role there, but we haven't heard a lot yet. Everybody's talking about AI in healthcare, but we haven't heard about AI in healthcare. So I think this is going to play out over a number of years. And the title of our year ahead report was to be fearless. Yes, we're going to have some corrections and pullbacks, and some of them might feel very violent. But our long-term goal for the S&P is 10,000 to 13,000. We're still in a secular bull market. And I still think a lot of news. I mean,
how long-term is that?
Till 2029 to 2030, so about another 4 years. I think we have significant upside.
Doubling.
Yes, towards the tail end of a secular bull market is where you get some of the greatest returns. But I want to remind people, you have Alphabet up today, and we've had great news out of Alphabet, and we were throwing it out with the kitchen sink like 6 months ago. So things will continuously evolve and change, but I think the trajectory for basically the Mag 7 and technology is still to significantly lead the leadership as we go out into the end of the decade.
Before we I want to touch on some technicals with you because that's what made you famous initially. But you mentioned the speed at which things are changing, and that brings up to me Michael Burry's depreciation argument, right? If you're going to spend $100 billion on these chips in 1 year, and something else worth $100 billion comes out the next year, aren't they worth far less? I mean, isn't that a huge problem, the overspend?
Well, I'm not an analyst. I'm not a semiconductor analyst. I don't understand all the depreciation. But I've heard arguments where, and even from Jensen Huang, where the lifespan of these chips is a lot more than a year. And so, there's always the bear story. There's always the bull story, right? Yesterday it was the bull story. Today we have the bear story. I think we have to take a much longer term focus on the trends and the evolution. We're in the digital era. We're going to continue to see upgrades and advances in technology. We don't even talk about blockchain. Blockchain is a great technology that is evolving in tokenization, which is going to allow things to move faster and cheaper. Virtual reality reality. I don't know if we're ever going to wear Meta's glasses, but there's a lot going on with Meta with virtual reality. Driverless cars are, I don't know if you've been out in San Francisco or Austin, Texas. Yeah. You can hop in a car and you don't need a driver. A little foreign, but obviously this is spreading, and this is the new era. And what I find is the younger generation embraces this. Right? Maybe the older generation has resistance, but the younger generation is embracing all this new technology. And I expect we'll continue to see new breakthroughs over the coming years.
By the way, Jensen Huang sending a note to sell-side analysts that Barron's saw basically defending itself against the depreciation thing, which I feel like you're losing if you have to be like, no, we're cool, we're okay.
Yeah, if you had to continue to try and convince the market,
right.
If you have to tell Ed Ludlow, like, hey, come on, our business is doing great.
Yeah.
It, I think, is a little bit concerning. I wonder if I want to go back to the technicals because we had a bearish engulfing pattern develop last week, which I'd never heard of that before, but apparently it's a very good sign that it has become a seller's market, or that the sellers are now on top. Is that still the case?
So a bearish engulfing patterns in candlesticks, and it is a very good indication that you're seeing distribution happen. And I am concerned that there's distribution. I think we can rally. I think we can go up into that distribution, but I'm concerned as we go into 2026, we're going to have an overhang in the market. And it's the midterm election year. And the midterm election year sees a lot of volatility from April through September. There are times we even have bear markets. I'm not calling for a bear market, but I think next year is going to have a lot more volatility than I think people are willing to price in.
Well, given that it's a midterm election year, I was speaking with Mike Wilson yesterday, who basically said that liquidity is going to be playing a bigger part, that this is a government that's going to be more supportive because of that. It's a Fed that maybe is going to switch to outright QE. Does that change the environment for equities, for risk, if that's happening, if you are getting checks handed out in a Fed that's more accommodative?
It definitely, if you get volatility where you're getting corrections, it puts a floor. It will stem how far you go down. So maybe we don't have a 20% pullback, you get a 10 to 15% pullback. But I'm quite concerned about the distributions that are forming, particularly in the growth area of the market, which is very tech heavy. So that's why we're telling clients to be fearless, that it's worth riding this out. We still see longer term upside, but it's going to be a choppy year, I think, next year.
All right, Marianne, great having you here with us. Thank you so much for joining us. Marianne Bartels there of Sanctuary Wealth. Let's get a check now on what's going on in the markets this minute. We're seeing not a huge red arrow, but we're down almost 0.2% on the S&P 500. The NASDAQ taking a harder hit because of the fall of Nvidia.
Coming up on the show, Apollo CEO Mark Rowan says people have lost their minds over private credit fears. We'll talk about this.
Defensive.
Yeah, well, this is an industry that's been defensive for quite the past month. We're going to dive deeper into it. That's coming up next on Bloomberg Open Interest.
Let's get to high interest now. Look at what's making headlines around the world. Treasury Secretary Scott Bessent says the Federal Reserve has become too complex and too loud. Wrapping up interviews for Jerome Powell's successor, he said the next chair should streamline the Fed's tangle of money market tools, from its ample reserves system to the standing repo facility, and tone down its constant public commentary. President Trump's pick is expected now before Christmas Day. The jobs market looks bleak unless you're in the corner office. While job openings are drying up for most workers, demand for top executives remains strong. A mix of burnout, retirements, and board shakeups is fueling turnover. Search firms say mergers, AI shifts, and activist pressure are keeping the corporate revolving door spinning, plus making out at Coldplay concerts. Apollo CEO Mark Rowan says fears over private assets in insurance and retirement portfolios are hysterical, arguing critics have, quote, lost their minds. He insists most private credit is investment grade and transparent, citing Apollo's daily priced fund with State Street. His remarks push back on UBS chair Colm Kelleher's warning of a looming systemic risk. And I believe he said, Colm is wrong.
Yes, I think that's exactly what he said, and he probably wanted to call a lot of other people wrong as well, maybe a Jamie Dimon. Let's get more on private credit with Bloomberg's chief Wall Street correspondent, Sri Natarajan. So, Sri, I mean, it's not new that this is an industry that's defending itself, and of course it is. This is Apollo's business. So how do you read his comments that everybody has lost their mind and there's nothing to the risks that everybody else is underlying?
So let's break it down into two separate lanes. One, both things can be true at the same time. There could be serious pockets of concern in a market that has grown rapidly, and yet there may not be a systemic crisis that takes down the entire industry. So Mark Rowan is right on that, but also I think he's overreading some of the headlines and some of the commentary from other executives that are pointing out concerns and sort of extrapolating that into thinking that the entire world thinks that private credit is a hot mess and it will go down in flames. But the other more important part in his commentary from yesterday was when he talks about private credit, he's like, you are all focused on this tiny sliver of private credit called the leveraged lending side of private credit, which is roughly $2 trillion. Private credit is growing into such a massive force that he wants to put the entire figure at about $40 trillion. And that by definition includes a lot of investment grade assets. And most people will tell you loans made to well-functioning companies are not really the problem here. So what Mark Rowan is saying is we as a business, we the credit behemoth Apollo, is invested in a wide swath of the market. And even if there are concerns in that $1.7 trillion bit, that does not mean that our entire business model is flawed. So he's not necessarily saying that the sub-investment grade corner of private market that everyone's truly honestly been complaining about has problems. He's not absolving them of any problems there. He's just saying that that's not our business model, and that's why you shouldn't be looking at any little problems and any cockroaches emerging there and assuming it'll take down Apollo.
But even that kind of misses the point of the BIS study, right, which said that in a serious downturn, insurers have, as an industry, a shortfall of like $150 billion. And the problem isn't that, Apollo hasn't done due diligence or isn't marking its assets to market. The problem is that these assets are illiquid and insurers have loaded up on them. So if all of a sudden everyone needs to sell and no one can, that's where the issue arises.
And the good players will come out just fine. The question is, when a market's expanded so quickly, so rapidly, is it full of good players, or do you have some bad players who've crept in where you will see problems? And the reason there is so much focus there is exactly because of this aspect. Now you have insurers plowing into private markets. We are talking about retirement accounts being loaded up with private market assets because most of this industry has tapped out with its institutional investor base, with its sovereign investor base. So now when it's coming for individual investors, you can expect that a lot more people will want to pay attention to this space because it's one thing for an institution to be hurt. It has a completely different optic when it's individual investors that are hurt.
I say, how much of this is even like behind the PR push that the Mark Rowans of the world are trying to make? Because they've all entered this kind of like asset gathering phase where they've tapped out the institutions and they're now looking to other sources of capital. Presumably, it's hard to break through to a wealth investor, to a retail investor, if they Google private credit, what is it, and like cockroaches pop up.
Look, that's a fair point. They have all been in an asset gathering phase for a few years, arguably, but what's really turbocharged that push is now more and more of that effort is being channeled towards the wealthy individuals, towards retirement accounts, towards these insurance accounts. So when you're focused on that side, and that's where your sales machine and your attention is, it's being sent in that direction, at that time, you don't want any headlines out there that takes away from the magic pitch that you're putting forward.
It's good that you're on set because we're getting breaking news from the FDIC right now, proposing changes to community bank leverage ratios. So basically moving to relax the bank capital rules tied to treasuries, which we all sort of realized, what this picture looked like as SVB collapsed. How important is this to regional banks to be able to boost their capital without worrying about the long-term treasuries that are on their books?
Look, I mean, there's no surprise that under this administration there has been this talk of a deregulatory wave. It's not just that's affecting the smaller end of the spectrum, it's been affecting the bigger banks as well. But people like Treasury Secretary Scott Bessent have talked about the idea that for too long we've been focused on making the bigger players bigger, and they've had competitive advantages. So the only way to make the industry more competitive is if you loosen some of the restrictions on the smaller banks. The question is, if there is another problem down the road, we can cater to the problem that we've already seen in the past, but if there's something else that comes up down the road, would we go back to this moment and point to this moment where we say, this is why you should not have been going on this deregulatory spree?
All right, Sri, thanks so much for joining us. Sri Natarajan covers the banks for us on the Bloomberg News side. Still ahead, President Trump is touting a $21 trillion investment boom, but a Bloomberg economics analysis shows real commitments are closer to a third of that. More on this report later this hour. This is Bloomberg Open Interest. Let's get a check on what's going on in the markets right now. Just about an hour into the session, we're looking at a loss of about 0.2% on the S&P. The NASDAQ down much more as Nvidia weighs on the tech-heavy index. The 10-year yield moving closer to 4 even right now at 4.0075. Coming up, we're going to talk to Caroline Styne of the Lucques Group about restaurants. Affordability is top of mind for many Americans this Thanksgiving week. Restaurants across the country are facing cost factors that many diners may not realize. A recent report from the Public Policy of California found food prices are running approximately 30% higher than 6 years ago. Joining us now to talk about this and all things fine dining is Caroline Styne, co-founder of the Lucques Group, founding member as well of the Independent Restaurant Coalition. Caroline, thanks so much for your time. Talk to us about what the main drivers are of these cost gains. Obviously, we all were there for the egg price run up, and now we're in the middle of beef prices going off the charts. What else are you looking to pay for?
Well, thanks for having me. But, prices are up across the board, and so many things have been affecting this. I mean, clearly, yes, we're talking about beef, poultry prices, all of those ingredient costs, food, supply, even on the supply side, packaging. We also are facing increases of produce, and a lot of this is coming from various sources. We have tariffs that are pushing up the prices of not only imported wines, but imported ingredients that a lot of restaurants use in their food preparation. We have pressures from local agriculture as well because of the immigration crackdowns and the difficulty of finding labor and the effects of those immigration crackdowns on farmers. And then, we have increased rents, utilities, labor costs are way up. It's just a really challenging time for restaurants at Thanksgiving when we're trying to keep things affordable for our guests.
Caroline, to that point, I mean, how much can you push up the prices at this point? You're obviously operating in sort of the upper stratosphere of offerings when it comes to restaurants. Do you have a consumer base that can absorb some of the higher prices?
I always say it's a really interesting thing for restaurants in that a lot of our pricing ends up being affected by perception, because if we could charge what we really need to charge to cover all of our costs adequately, our prices would be much, much higher. And we are definitely feeling a push from our clientele in terms of how much they are willing to spend. Look, it's really expensive to go out to dine right now, anywhere you go. It's expensive to go to the market. So we're trying really, really hard not to raise our prices. I mean, our costs are up for Thanksgiving this year, but we have not raised our prices for our Thanksgiving to go because we just know that there isn't a tolerance for it on the consumer side. So we're working harder. We're making less. And for restaurants, a lot of people don't realize profit margins are incredibly thin. So the fact that anybody can even turn a profit right now is kind of a miracle. Most restaurants are not, and we're seeing a lot of closures because of that.
Your prices aren't off the charts for New Yorkers looking at your menu. the main courses are between $20 and $40 essentially. But do you end up having to cater to just the top quintile of consumers, Caroline? Because it looks like the bottom 80% is going to have a difficult time forking that over.
Yes, I mean, it definitely becomes a question of those who have and those who have not, who can afford to go out and spend that kind of money on dinner. And, we see it in terms of repeat customers, in terms of our guest flows, because people are just dining out less. They're just going out fewer times. They're spending less when they're out. And it really affects our revenues and our bottom lines, restaurants all over California, all over the country, because we really thrive on volume. We need volume.
I noticed also, at least on the AOC menu, a 6% charge is added to all checks to cover the cost of health care benefits for eligible employees. Is this something more independent restaurants are doing? Because clearly health care is at the forefront of affordability conversations.
It is. A lot of restaurants are doing this, and it's not any sort of political statement. It's also a way of keeping this cost separated and segregated for our guests, and for keeping it out of various revenue calculations, in terms of rents that are based on percentage of sales, other kinds of costs that are based on percentages of our sales. We can keep that service charge out of that calculation. And instead of marking up our menus 25% to cover the healthcare charge, the cost of the healthcare plus those additional fees, we actually keep that a little bit lower for our guests and keep it at 6%.
Caroline, this is an administration that's also been more keyed in on the issue of affordability, especially given some of the midterm election losses that it had as part of that. They've been talking with Brazil, and they're rolling back the tariff on things like coffee, on beef, on fruit and cocoa. When you've been talking to some of the suppliers, have some of that started to trickle into costs elsewhere?
We haven't seen that yet ourselves. And, it's not as if everything we buy is from that particular country. I mean, we buy a lot of products from France, Italy, all around the European Union, Mexico. And so, we're still seeing an increase in a lot of costs. And a lot of the importers that we deal with are actually absorbing these costs. So they're making less. Some of them are closing down because they're getting pushback from their customers who are buying it to resell it. And it's just, it's creating an inability to keep your business open and keep these companies afloat.
One question I had, and I'm not sure how much it applies to you because you're clearly focused on wine, right? At least at AOC, that's not a reference to Alexandra Ocasio-Cortez. It's a reference to, it's a wine phrase that I'm not familiar with, but that's what my producers tell me. Do you have people drinking less alcohol? Because that's a trend that we've been seeing around the country with the legalization of cannabis and these like anti-anxiety drinks. We were talking yesterday about one called Trip. Do you have people that are running up smaller bills when it comes to the booze?
Yeah, people are definitely drinking less. I think we're down about 20% in terms of what the public is consuming in terms of alcohol. A lot of restaurants are actually trying things like non-alcoholic cocktails, which are a great way to provide something for those guests to be able to enjoy that doesn't have alcohol in it, but that also feels like they're having something celebratory and something sophisticated. But some people are still spending money on pairings for dinners that are non-alcoholic, that can be just as expensive as alcohol. So some restaurants are figuring out ways to make up for that.
Very interesting. It's like adult fruit juice paired with your very nice meal, Caroline. Thank you so much. Caroline Styne of the Lucques Group. Obviously, it's nicer than just a fruit juice, but it kind of feels like that. I'd rather get my calories elsewhere.
I did not know that AOC stands for Appellation d'Origine Contrôlée, which is
Great
a French
pronunciation.
I know it's bad, but it's a French certification system that guarantees a wine's quality, origin, and authenticity.
Yeah, there's a lot of that in Europe, like the Champagne designation. In Italy, you have a different one. It's all very complicated.
I wonder what that is for weed now.
I'm sure there must be one. If not, it's a market waiting to be cornered. All right, let's get a check on markets this morning because you are looking at a S&P that has turned positive, up 0.05%. So, okay, barely positive. The tech index, the NASDAQ 100, though, that continues to lag considering just how much Nvidia is falling this morning. That's down 0.5%. 10-year yields, those keep moving lower towards 4% after some pretty bad consumer sentiment survey and recent Fed officials from Williams to Mary Daly that seem to be forcing the idea of a cut come December, Matt.
Yeah, WIRP, the World Interest Rate Probability Screen, now showing that the chances of a cut are about 80%. And like you said yesterday, there are so many hawks coming out that it didn't make sense. But the markets do what the markets
Well, it's because Mary Daly is supposedly so close to Powell that she rarely breaks with him. So if she's saying there's going to be a cut or that she's worried about the labor market, then apparently that's what Powell will be worried about.
She's like the Chinese state-run TV of Jay Powell. Let's get a look at some of the single stocks moving at this hour. Kohl's raised its full-year outlook for the second straight quarter as it names Michael Bender permanent CEO, and they needed it. As you can see, the shares are up 33%.
Also up a lot this morning. Abercrombie, those shares up 28%. They boosted their full-year sales outlook. Hollister, that is continuing to gain momentum.
Again? Okay, Dick's raised its forecast, but investors are concerned about the costs of trying to turn around the Foot Locker, the sneaker chain that it recently acquired. And although the stock has been on fire for the last 5 years, it's down 3.25% today.
Yeah, maybe it was a mea culpa to buy Foot Locker. At least they're spending a lot trying to turn it around. Coming up, a Bloomberg economics analysis shows President Trump's $21 trillion investment boom is short by many, many trillions. We're going to discuss the latest big take coming up next.
President Trump says he's brought $21 trillion investment boom into the U.S. in less than a year through deals with governments and companies around the world. Our latest big take examines the White House's data and the actual announcements, finding that the reality is far, far less. Joining us now is Bloomberg senior writer for economics, Sean Donnan, who co-wrote the big take. And Sean, I thought when I clicked on this story, it was going to say, actually, it's only 19 trillion or it's only 7 trillion. But it may be even less than that, right?
Yeah, look, our calculation right now is that if you look at all the investment pledges that the White House actually details, you're probably looking at about $7 trillion, which is a third of what President Trump says when he talks about $21 trillion. And we should say that that $7 trillion comes with a lot of questions attached. A lot of what's in there is pretty amorphous. It's also, these are pledges that have been kind of amped up by CEOs and countries that have been sitting down to negotiate with the president.
I guess as we're thinking of how this impacts the economy, Sean, what is sort of a threshold that it still makes a difference? Like if 7 trillion still does come to realization, is that still a boom for the American economy?
Yeah, look, and that's the amazing thing about President Trump's kind of hyperbole, if you will, is that $7 trillion would still be a pretty historic influx of capital into the American economy over the next 4 years. That works out. If you look at the timelines of the pledges and so on, it looks like it would be about $1.5 trillion a year. That's into an economy that now sees about $5.4 trillion in investment, in private sector investment annually. And if that came on top of that, that would be an extra 5% of GDP. And that puts it on par with some of the big kind of economic events in history. You know, the New Deal is somewhere around there. If you look at the railroad boom in the 1880s, it was up there. You know, some of the big fiscal interventions that we saw, the kind of rescue packages that we saw after the Great Recession in 2008, 2009, and also the pandemic response. So even at $7 trillion, at $1.5 trillion a year over the next 4 years, that would be enormous. But like I say, that still comes with huge questions. We don't know if that's going to be entirely new on top of what we already see in the economy, or simply it's companies and countries kind of saying, look, this is what we're doing already. Maybe we're going to juice it a little bit, and we see something more modest.
You know, it's a fantastic piece that you wrote together with Chris Kennedy from Bloomberg Economics and Adrian Tong. When did you guys figure we're going to see receipts for this? Like, at what point will either you be proven right, in a sense, or President Trump?
Look, it's gonna take a while. This is the kind of, if you will, the positive side of tariffs, right? There's been a lot of chatter recently about prices and affordability and the impact of tariffs on that. Well, the benefit of tariffs that President Trump has been talking about is this investment. When are we going to see that actually show up in the GDP numbers? And that's where we're going to be looking, laser focused on the kind of fixed investment line in the GDP figures. Like I said, that was around $5 trillion. That was the annual rate that we saw in the second quarter. Where's that going to go in the third quarter? We're going to see those numbers in a few weeks, and then into next year. The White House says, in response to our story, said, well, this is just media nitpicking. There are trillions of dollars in economic activity happening. And some of that is true. The question is it trillions of dollars in new economic activity? And is there going to be a big payoff for these tariffs, which right now the polls show voters aren't entirely enthused about?
$1 trillion from the Saudis, $1 trillion from Japan. It's pretty amazing. And the story, I think, does an excellent job of framing that in historical terms. You mentioned the railroad boom and the New Deal. This would be it would be about the same as, a little bit less than the railroad boom, but almost as much. Still, it's shocking that the COVID investment, the pandemic recovery money, was so much more, like double this boom. It's hard to believe that we spent that much. Is that like the same as what we would have spent during World War II, for example?
Look, in peacetime, it's significantly higher than you'd see normally. That doesn't kind of match what we get in World War II. When the country goes to war, it really pulls out all the stops, and we saw much higher influxes into the economy then. But in the peacetime economy, the pandemic was a war against a virus, right? So it's hard calling it a peacetime influx, but, that really stood out. We also should remember that had consequences for the U.S. economy. A lot of economists blame that influx of capital, that fiscal impetus for driving the inflation that we saw in recent years, which also came at a political cost. So, if this investment that we see, if we see it, is not kind of productive investment, if it's into kind of bubble areas of the economy, then, perhaps that will drive more inflation, and we'll be back to kind of totting up the costs of that. The other big thing that really stood out from our analysis here is just how dependent this investment boom is on AI-related investment. And we've seen in the markets just over the last few weeks a lot of concern about whether there's a bubble there. Well, we should also remember that there's consequences for the real economy. There's consequences also for President Trump's investment boom and whether it actually happens.
Hey, Sean, fantastic reporting from you and the team. Thank you for bringing it to us, Bloomberg's Sean Donan. Now, coming up, reports say that Ukraine accepts the U.S.'s peace deal to end the war. Maybe Russia doesn't. The back and forth, we'll have that for you coming up next on Bloomberg Open Interest. The White House is signaling optimism around efforts to negotiate a peace deal between Ukraine and Russia, but they've also warned that additional talks to address remaining sticking points would be necessary. Press Secretary Caroline Leavitt says the details are delicate but not insurmountable. Bloomberg's White House and national security editor Michelle Jamrisco joins us now from Washington. And Michelle, this came off the back of reports from various media outlets that maybe there was something agreed upon, maybe Russia had an issue with it. There seems to be a lot of back and forth. What do we know at the moment for the likelihood of a deal to come to fruition?
Well, not a whole lot, Dani. And, you know, we've been on this roller coaster, but the important thing about roller coasters is you start at the same position that you end up. So it certainly feels like we're back where we started again, with the White House kind of walking back these expectations. Yesterday, we heard things a little differently from Caroline Leavitt herself in talking with tremendous optimism about what was, what we thought and what other reports were saying we're getting close to a deal. But at this point, you know, it seems like the same sticking points could remain. The White House has been talking about one or two, a couple of points that still need to be worked out, at least with the U.S. and the Ukrainian sides. And then the Russian side is a whole other story. So we're hearing a lot from both sides. Of course, the only thing that they all seem to agree on is that nothing is completely agreed. So we're awaiting just next steps on who's meeting who and where. And we'll have to see if the rest of the week brings a little bit more development, at least on the meeting stages.
Does the fact that Russia is a nuclear power and that Vladimir Putin is a somewhat unpredictable dictator mean that we're going to have to give them some of the land that wasn't theirs before this? I mean, because no one else is willing to step in and fight on behalf of Ukraine, like actually put boots on the ground there. So does that mean we have to give regions of Ukraine to Russia in order to get them to back out?
Well, Matt, that's history's big question. It's been the decades-long puzzle, right? But I think the other side, the counterpoint to that, including from voices within the president's own party, is that the Russian economy is weak, that Putin is actually in a vulnerable position in some ways. And so now is the time to strike with more sanctions, with more pressure applied through allowing Zelensky and Ukraine to have more support from the U.S. and its European allies. But the trouble with that is that, we're not any closer to a peace deal. And that's what Trump has really been looking for. So he's been applying pressure. Recently, of course, we've seen a little bit more on Zelensky himself for some domestic troubles that he has and some lack of support that he has in his own country. And Trump, you see, really trying to take advantage of that and leverage in negotiations. So we'll see what comes out of this. But the U.S. side is pretty clear. They're growing impatient. Trump is growing impatient with both Putin and Zelensky, and at various times he's been kind of trying to play them off each other to kind of bring them to the table for this peace deal. But, it ain't over till the president actually weighs in. He's got a couple of events today, and then he's headed down to Mar-a-Lago. So we could see, some more activity, or at least another announcement of what comes, in the meeting space today. But, as yet, we don't know who's meeting who and where this goes from here.
All right, Michelle, it's a fascinating story, and I'm sure we'll listen to more of it unfold on Balance of Power that kicks off at noon on Bloomberg Radio, 1 o'clock on Bloomberg. Are you co-anchoring Balance of Power today?
Not today.
Well, you do a fantastic job when you do. So, Michelle Jamrisco in Washington, thanks very much. Joe Matthew will be handling that with someone capable, I'm sure, at 1 o'clock on Bloomberg Television. Then they come back at 5. Let's get a check on the markets here as we come to the top of the hour. We're looking at little change on the S&P, but after a pretty decent rally yesterday, up 1.5% to over 60, in fact, to just about 67.05. Coming up tomorrow, strategist Mona Mahajan of Edward Jones joins us, plus Stu Leonard's president, the CEO, Stu Leonard himself, ahead of Thanksgiving. This is Bloomberg Open Interest.